These 5 investors are convinced they are building a great portfolio, but each one of them is making terrible mistakes that one way or another many investors make. So today we're going to check the portfolios of Mark Focus, Lisa Dividend, Diversification Dan, Tina and Dave Stockpicker. And we're going to find out which mistakes they're making and how you can fix yours. My name is Rick. If you're new here, say hi in the comment section below and subscribe to the channel. And now let's go straight to Mark Focus, who is an investor that loves semiconductors and growth. Maybe too much. Mark took the phrase invest in what you know a little too literally. Mark is convinced that the future belongs to semiconductors and tech. And honestly, he's not entirely wrong. The problem? That's the only thing he invested in. Mark's portfolio is 100% made of ETFs like SOXX, SMH, TECL and QQQ. When Mark wakes up in the morning, he thinks, why would I invest in boring stuff like healthcare or utilities? Tech is the future, and he had the best performance so far. But here's the problem. Mark enjoyed the best decade of technology ever, and believes that this means it's going to be like this forever. So when tech goes up, Mark feels like a genius. He mocks those who buy generic or value ETFs. But when technology crashes, and it does crash, Mark's portfolio nosedives faster than a meme coin on a Monday. There is no safety net. No cushion, just raw, concentrated exposure to one sector. There are some things that Mark gets right. It's probable, for example, that tech will overperform over the next 20-30 years compared to other sectors. And it's also probable that semiconductors will be one of the fastest growing sectors because of ever-growing demand. But Mark made a fatal mistake. He didn't consider the fact that he's buying this sector at the highest price ever, with a price-to-earning ratio that is in an extremely dangerous area. And look at this. The price of the sector grew 735%, but revenue and earnings grew only 166 and 216% respectively. Remember, in the long term, the stock price must tend to the same growth of the earnings. If it grows more, at some point the growth must slow down or even crash down to get back to the growth of the earnings. So whenever you see a sector whose price to earning ratio grows too much over time, that is never a good sign. So Mark made 2 mistakes. Number 1, he had too much faith in the semiconductors industry without taking into account how overpriced the sector is. Number 2, regardless of if the sector will grow more in the future, he underestimated how hard it is to hold a portfolio that crashes 50% without selling at a loss. So let's get to your portfolio. If you like tech, that's great. If you have faith that semiconductors have a bright future, it's okay. But instead of going all in, blend it into a diversified ETF portfolio with a core position like VOO or VTI that should cover a bigger portion of your portfolio. Lisa Safe instead is a kind of investor who loves to hear the word income. Passive income, dividend income, monthly income, you name it, she's into it. Lisa's portfolio is made up of SCHD, VIG, VYM, HDV, the Dividend Aristocrats fan club, and 0, I repeat 0 growth ETFs or innovative sectors. Lisa wakes up in the morning with this thought. Dividends are proof that a company is solid and profitable. They pay me every quarter, and the feeling of receiving dividends motivates me to invest more. And on paper, Lisa is not wrong. Dividend ETFs are often full of stable, mature companies. The problem is, they're also often full of low-growth companies. Lisa is 30 years old. She has decades of investing ahead of her, and she's investing like she's already retired. Even if she reinvests the dividends, which is, by the way, what she should do to speed up the growth, she still reinvests in dividends that have been taxed, which is a disadvantage compared to a company that before taxes decides to reinvest the money into growth. If you want to imagine the opposite of dividend companies, think of Mr. Beast. He always reinvests everything he has into making better videos. He could have kept the money, have it taxed and put it aside. Instead, he knew that only by innovating he could grow to the point he is now. Or think about Amazon. Jeff Bezos always talked of Amazon as a company that makes no earnings. But it wasn't because they weren't earning, it was because before the end of the year they were always investing all their money to make the company better. Companies that instead pay out profits as dividends often do it because they don't know how to reinvest them for growth anymore. Not always, but often. So they live off the competitive advantage they built against their competitors, but use this money as dividends instead of for innovating their companies. So what's wrong with Lisa's approach? She overexposes her portfolio to slow growth companies. She ignores total return in favor of income, she avoids tech stocks because they don't pay dividends, and builds a portfolio around comfort instead of performance. To fix this, if that's your case, Know this. Dividends are totally fine. They can be part of the strategy. But if you're in your 30s, 40s, or even 50s, you should care more about total return than quarterly payouts. Use dividend ETFs as a bonus, not as a foundation of your portfolio. And try to balance growth and value. Remember, Lisa's portfolio pays her every quarter, but in the long run, it might cost her the real gains. The third investor is Diversification Dan, the investor who took one lesson from every finance book ever written. Diversify or die. Dan took it a little bit too literally. His portfolio is a giant buffet of ETFs. VTI for the total US market, VO for the S&P 500, SCHX for US large caps, QQQ, SPYG, VGT, and MGK for growth, and of course a handful of international ETFs like VXUS, VEA, and maybe even a small cap ex-US ETF, just to be sure. Then meets a friend in a cafe, and when he talks about investing, he says, "I don't want to miss out on anything. Better to own everything just in case." So here's the problem. Then he isn't diversified. He's overlapping. He's holding multiple ETFs that track the same companies. VTI, for example, already includes VO. VXUS and VEA are nearly identical. And maybe he also has a bunch of companies that are already in his ETFs. So what Dan thinks is diversification is really just doubling, tripling, or quadrupling down on the same stocks and paying extra fees for it. Now, we all have some sort of overlap, and it's important to know that not all overlap is bad. In fact, if you have the S&P 500 as your core position, but you want to tilt your portfolio towards growth, for example, because of the performance, no matter what you buy, we'll probably have companies that are also in the S&P 500. Or whenever you buy single companies, they're also probably going to be in the S&P 500. But there are a couple of mistakes that Dan is making. Number one, he has too many ETFs tracking similar indexes, which in reality means just repeating the same companies. And second, he's making his portfolio complicated with no added benefit. Think about it. He has more ETFs, he probably has some of them with a higher expense ratio, and managing his portfolio and rebalancing is going to become more and more complicated. So how do you fix this if you have this kind of portfolio? You don't need 12 ETFs to be diversified. Sometimes less is more, as long as what you pick is broad enough. Something like VT, the Total World Stock Index Fund ETF, or a simple combo like VTI plus VXUS gives you exposure to thousands of companies across the globe, and it keeps your portfolio lean, efficient, and effective. Say hello to Timing Tina, the fearful investor who always waits for the right time to invest. Tina isn't reckless. In fact, she's too cautious. She always invests when the market is going well, but as soon as there's a crash, she's the one that comments finance YouTube videos with, "Yeah, go ahead and invest your money and toss it down the drain. I'll just wait and hoard cash." So Timing Tina makes a particular kind of mistake because her portfolio is going to underperform, not because she chooses the wrong ETFs, but because she always invests in the wrong moments. In her mind, she's doing the right thing. Why would you invest in a stock market when it's crashing, when most likely it's going to crash further after you invest? Better to wait on the sidelines during downturns, watching and waiting, and only jump in once stocks have already gone up 20-30%. Then, the moment headlines turn scary again, you stop investing again and go back to cash, waiting for the next safe moment. This is the biggest mistake I see people make. And I noticed also in February and March this year that some people on my videos were reacting exactly like Timing Tina. The logic these people use might seem right, because they just say, the market is unstable, I don't want to invest when the market is down because it can go down more. But while this logic makes sense and improves your return in a short period of months, in the long term, it's going to destroy your returns. So after decades of investing, Tina finds herself with a third of the net worth of a person that instead invested during crashes. I made a whole video where I showed the results of my personal study, where I backtested 50 years of stock markets and proved mathematically that you achieved a better return by simply investing the same amount regardless of what the market is doing. And this is called, by the way, DCA, or dollar cost averaging. I linked a video here and in the description below if you don't trust that DCA is the best method and you want physical evidence. But for now, know this. Our investor Tina buys high and sells low. Again and again. She's always either too late to the party or gone just before the party begins. She thinks she's playing it safe, but she's really just sabotaging herself with poor timing. And her portfolio never compounds properly as it should. To avoid this, if you think that you also make this mistake, the best way is to accept that time in the market is not a good choice. Use dollar cost averaging, stick to your strategy, and remember, some of the best days in the market happen right after the worst ones. Now let's meet Dave Stockpicker. Dave doesn't really have a portfolio. He has a collection of hype. Palantir, Lucid, Rivian, Teladoc, DraftKings, AMC, Lemonade, Virgin Galactic. If it was trending in 2021 or it was mentioned on a Reddit post, Dave bought it. He also has all the companies that most people have, like Apple, Microsoft, Google, Meta, Nvidia, and maybe those are not really bad companies, and the problem with those is that he bought them when everybody was talking about them. So guess what? He bought them overpriced. Someone mentioned Coinbase in 2021 because of the crypto hype, he bought it right away and made a loss. Someone in the end of 2020 says Zoom is the new normal because of COVID and home office, he bought it and made a loss. And let's not forget GameStop. God forbid Dave didn't buy GameStop, a company expected to grow 1,000-fold in a year. Are you crazy not to buy it? The result is 30 plus individual stocks, no plan, no strategy, just vibes. And worst of all, Dave thinks he's diversified. But is he really? Now, there are a couple of terrible mistakes here. Some are obvious and some are not. The obvious one is that he bought all these companies when they were in a hype, so they were overpriced. Another big mistake is that Dave didn't invest time in learning how to analyze companies' fundamentals, let alone analyzing the ones of the companies he bought. And while it might seem complicated, there are some basic things that you can check in a company to understand if it's a good company to buy. Check, for example, if the revenue and net earnings are growing over a long period of time. Check that the price to earning ratio hasn't grown too much in the past few years. Check if they have increasing free cash flow or low debt. These are really easy to check by using sites like quickfs.net. And if you're interested in this, let me know in the comment section below and I can make a video about it. Dave also underestimated the work needed to check these companies over the years, because it's not only about buying them, it's also about checking over time if something bad happens to their fundamentals. Remember, a good company can even crash and fall down the gutter if they don't make good decisions in the long term. So here's the mistakes Dave made, and here how you can avoid them. Dave chases narratives, not fundamentals. He confuses popularity with profitability. He spreads across dozens of companies, but they are all high-risk bets, and he doesn't know how to keep his portfolio under control. To fix this, if you don't want to research balance sheets, management, or industry trends, use broad diversified ETFs instead of individual stocks. They already include strong companies and balance the risks for you. And if that's not enough, find out how to create the perfect ETF portfolio by watching this video here. And trust me, this is a good one. But don't forget to subscribe to the channel, because the best way to learn about investing is by learning from the mistakes that other people made, like me.